Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So today I have with me Lisa Hylton. Lisa is the host of the Level Up REI podcast, and she's been in the real estate space for quite some time. We're going to talk quite a bit today about investing in funds versus syndications. Sort of her background lies in that area. She's been a limited partner, so it should be a really great conversation to hit on a bunch of really good topics to help you sort of get to the point where you get the confidence needed to make maybe your first allocation, or just hoping to make you a better passive real estate investor. So Lisa, why don't you share a bit with us, kind of your background and how you got into the this space, and really what led you to kind of get to the point where you're syndicating and investing as an LP. And I think it'll be an interesting story for people to kind of hear how you worked your way up and got to this point.
Totally. So I grew up in a real estate family. My father was a contractor. He built 14 apartment units. So as a child, I was always around apartments, property management. They manage them themselves. And still to this day, my parents still have that. However, my father was diagnosed with a brain tumor when I was in middle school and passed away by the time I was in college. Through that time, he was also the primary breadwinner for my family. Because he built those apartment units, that's what enabled my family, myself and my two younger siblings, to continue to be able to go to school and then eventually off to college. So for me, I didn't really see real estate as an investment vehicle, even though I was around it all my life. I went off to school, got an accounting degree, went to college, came out, started working for an accounting firm, bought my first place in the Cayman Islands in my early 20s. It was a 2-bedroom, 2.5 bath. Bought it because I loved it, and it broke even the first year, lost money every single year after that for a total of 6 years. During that time, the first year I lived in Cayman and it was breaking even. And then I moved to Boston. So I was an out of country landlord for the rest of the time. Could not afford property management because it wasn't something that I thought about, because I was like, I was going to be living in Cayman. Why do I need that? Later on, I realized very quickly. So moved to LA, ended up getting a bill for over $1,000 from the AC company and said, okay, this is it. I'm selling this place. No more real estate. I'm done with real estate. I'm finished. And I say the universe has a sense of humor, because a year later, I ended up taking a job working as a controller on private equity real estate funds. And it was during that time I met a girl. I knew a girl who was there who left a month after I started. And she said to me before she left, it'll take you 6 months to figure out what you're doing here, and then another 6 months to determine whether you like it or not. And in that second 6 months, I realized, I can do this job, but I don't see myself working in corporate America for the rest of my life. So I'm going to need to figure out a way for the next chapter. And it was during that time I started listening to podcasts, reading books, going to real estate events, meetups. And I started thinking, one, to get a duplex here in LA. But the duplex is 1.something million plus additional money to fix them up. And it was just not a part of my budget. So that moved me to turnkeys out of state. But I just couldn't pull the trigger from my previous experience. And then about a year or so later is when I got introduced to real estate syndications. And I was shocked, because I was used to them from an institutional perspective, and I figured only big institutions could invest in these kinds of deals. Then I got introduced that, hey, regular people can do this too. And it totally blew my mind. I made my first investment, and I've done 5 to date and 1 fund. I'll stop there.
Great. Yeah, it's always interesting to hear kind of the early exposure, right, to real estate sort of always weaves into most of our lives, whether you realize it or not. I mean, real estate's everywhere. It's funny. Yeah. I swear it off. Don't want to do that. And then that's sort of that juxtaposition against the syndication, right? Of Because I think a lot of people do. They just think that, well, if you're going to have a real estate allocation in your portfolio, it's either REITs or, you got to go buy a single family residence and rent it out or whatever, which usually ends up
Right.
being more work than people are like, I don't want to do this, it's
Exactly.
it's just a pain, right? So for you then, when you did, going into it and working at a private equity real estate shop, in a controller capacity, of course, can relate to that. We have a whole team of fund accountants who do that for a bunch of clients, and it's
Sure.
a steep learning curve. It's far different than being the controller at a operating company, or it's a different thing. But what did you find in that experience? Like your coworker said, hey, 6 months to kind of get the lay of the land, and then figuring out whether or not this is what you want to do with your life. In particular about real estate,
Right.
what sort of surprised you? I mean, were you guys was it institutional investors investing into your funds there, or?
Yeah, 100%. Once I took that job, I realized the first thing I realized was like, wow, there are people investing in real estate making a lot of money. And I did also see people not make a lot of money too, right? So you see both. So I think that's the biggest thing is, I saw that, and I saw it for myself. I didn't see that it was possible to invest in like a large multifamily. Like I didn't see that until much later when I was introduced to syndications.
Yeah, because that is what we see too. I mean, there's a huge difference between sort of the institutional side of these things, and just how everything works, and it's just a different. Even though fundamentally the mechanics are much the same, it's just the and we really only service those who are sub-institutional, right? So it's not those. It's a bunch of high net worth people investing in, people that are either syndicating or they've launched a fund or whatever. But it's very much the people that are represented in that. It's just a different thing, and institutions, right? They have a legion of people, right, to sort of keep tabs on the fund managers, right, to make sure everything's going and all the reporting and all those sorts of things. But people, you're the common man, the high net worth people or whatever investing into syndications, you just don't have that same kind of pull, right? And so, and
Exactly.
then the due diligence for those things, and I feel like that's where I'm interested to hear from you, sort of having experience and exposure to that, and you've now allocated into a fund. What can you kind of share from an LP's perspective as to how to get comfort from going? It's one thing to say that apartment building in that city run by that person to, putting money with people that are going to invest in assets that aren't yet named. So how did you find yourself looking at the due diligence part of that differently, like how you were underwriting, investing into that fund versus the 4 single asset syndications?
Yeah, so a couple things to note here. So I've personally invested in real estate syndications. The fund that I created was a single asset fund. So I did not do a blind fund. So for people listening, there's like single asset funds, and then you have blind funds. And the blind funds are like what you're describing. They come up with the strategy and what they plan to purchase and all that kind of stuff, but it's not purchased yet. So you are really trusting them. And we can talk a little bit about that. So some of the key things for someone who's looking at investing in a blind fund, the sponsor. It's super important to be comfortable with their track record. So I know track record is uber important because as people wanted to invest in new funds that were being raised, they want to see how other funds have performed. Like what were the assets that were in those funds? What did they sell for? And what were the projections versus what actually happened? So a lot of record keeping in terms of providing returns to investors for them to get comfortable with it. In addition to, talking to the people, the portfolio managers who are then running those funds to then get comfortable with it as well. that said, for someone who today is looking at funds from a perspective, there are a lot of syndicators who are now creating funds. So like a multifamily fund for like 100 million, or, those are I see them a lot. Maybe other people aren't seeing them, but I do see them a lot. I think a couple things that people need to ask is about when the money is going to be called. What is the return on that money?
Yeah.
Like, when does the return start? Because typically in the institutional world, the moment you call capital, the preferred return begins. And that's like an 8% preferred return starts ticking. So just understanding, maybe it's not 8%, maybe they're going to do maybe 2% or 3%. Whatever it is, understanding what it is, so that way you are comfortable with whatever return is going to be provided on your money. Or if there's no return, that you're comfortable with that too. And then I think the second thing, as you're thinking, because we're not talking to institutional investors, we're talking about everyday people who are now looking at funds to invest in. So I think, asking about track record. I think it's really good to see a fund manager, not a fund manager, a sponsor that has done many deals, like if they're doing a multifamily fund, that they have done multifamily deals that have successfully gone full cycle, that they've managed and they've taken care of. That then illustrates a level of trust, because that is what's going to be needed to then make an investment into this fund. Because really and truly, in terms of underwriting the fund, there's no deals. So really and truly, you're looking at track record and you're getting to know them as people. And, potentially a lot of these syndicators will also allow people to invest into the investment outside of their fund. So they'll create a fund, and then they'll also have regular syndication so people can then do one-offs into those deals as well. So it might be beneficial for you to, do a one-off in one of those to then get comfortable to how they communicate, to then be, okay, you know what, this makes sense for me. This is the path. I like how they communicate. I like how they take care of investor relations. I'm going to continue to invest with them. So I would say those are some of the key things. Digging further, as people decide to build a fund, team is so important. So a lot of real estate syndicators, they're just getting started, but if they now are moving into the space of a fund, in the sense of having multiple assets, they now are going to need a team. Because deal flow is super important in order to deal with the first point that I mentioned, which is providing a return on people's money. So now it's like, okay, looking to see who is their team. And I've seen that for a lot of the people who have funds now, that they've built out a team. They have an acquisitions manager. They have an underwriter. These are full-time people that are on their staff now that are constantly underwriting deals, looking for deals. It's an entire system. And that is what's required if you're planning on, growing into that space. And as an investor, you want to see that to feel comfortable making an investment into that kind of fund.
It's definitely, the pipeline, having an acquisition strategy that's going to, create opportunities on an ongoing basis. I mean, it has to be there. If you don't have that, then the fund doesn't work, and it creates, all sorts of issues. And just having a team, there's certain seats that need to be filled. I mean, who's in charge of acquisitions? Who's in charge of asset management? Who's in charge of raising capital, those sorts of things. And when there's no one occupying the seat, or the same names in multiple seats, it's a bit of a problem. I mean, especially for, if the same person's in charge of doing all the acquisitions and negotiation, and they're the ones supposed to be, doing the asset management or the value add strategy, it's like, it's not going to work out, right? It's too many plates to be spinning.
Yeah. Yeah, 100%. I think two other things that I'll also mention here. So one of the benefits of investing in a real estate fund is diversification. And real estate syndications can provide you with some diversification, because I have definitely seen syndications that have, say, two assets, sometimes even 3. I've even seen some that have 26 assets. So it's definitely possible to invest in real estate syndications that are diversified in that way. Typically, the funds that have multiple assets typically will provide a lot of diversification in the sense that you're not just betting on one asset to do well. So your 50K goes into that fund, just like how it could go into a single asset fund or single assets like typical syndication. If that deal doesn't do well for whatever reason, that's your entire 50K. Whereas if you invested it into a fund that is now invested in like 10 or 15 different investments, that helps to diversify your investment. It's one of the reasons why a lot of people like investing into funds, because it provides them that ability to get some diversification while still being in real estate and still getting the tax benefits of real estate as well. Unlike with REITs, that doesn't provide that tax benefit. It's sort of lost when it gets down to the holders of the REIT investors into those shares.
Yeah.
And then the last thing that I wanted to speak on regarding funds is that, funds don't always end on time.
Yeah.
And that's something to just be mindful of. Like, all investing comes with risk, and just like anything else, you're taking a risk. There's no guarantees in anything. And sometimes the fund might go on longer than what is planned because maybe it's not the most ideal time to sell. And when you're dealing with multiple assets, you are trading off, you get diversification in exchange for you give up control over when all of these assets are going to sell, because they're going to do the best they can to sell them within the time period of the 7 years, but it could lag on to like 14 years. So like I worked on funds that were as old as I was.
Yeah.
So yeah, and that happens. It didn't plan to be that way, but yeah, it just happened.
Yeah, it's a great point. I mean, it's just a lot of, a lot of the reasons why you're able to generate these outsized returns, I mean, has a lot to do with the lack of liquidity. I mean, real estate is inherently illiquid. So the fact that you can't move these assets as quickly as you can a stock is sort of baked into that's part of some of the premium that you're picking up, to invest. And so, it's not as efficient, right? Like these markets, especially in the sub-institutional space, these real estate markets are very inefficient. And that's what creates the opportunity, the ability to buy, below replacement cost and all those things. But on the flip side, the market cycle, it's difficult to time when, like the cycle we're in right now. I mean, it's been going on for 10 plus years. Real estate markets typically last 7 years, or whatever. And the cycle's not even done yet. But so those are the things that you have to think about is, to your point, it's just because the term says they're going to do this, they're not going to go and just start selling properties. They're not going to take a loss on properties because the market cycled if it's fundamentally good real estate.
Right.
And that's what you can see, being extended out. And so that's why some of these people who have, some people just have too much allocated to real estate. I mean, that their whole portfolio is tied up in, the percentage of the portfolio in commercial real estate is, 50, 60, 70%.
Mm-hmm.
Well, commercial real estate assets, multifamily, I'll lump them in sort of into the commercial real estate is just not that liquid. Now, single family, that's sort of the benefit of it, right? Is that single family properties, your ability to sort of, sell them off and get rid of them is far easier. And so those are the things too, as you're constructing a portfolio, you gotta think about. And, but a lot of times, like you said, to get the instant diversification, the funds can be a great way to go, but you got to make sure, who's the manager, right? Like you said.
Yeah. Looking at the track record is super important. And that's pretty much all you have, is like looking at the track record of what they've done in the past.
Yep. No, totally agree. So for you, then you did mention that, you were sort of differentiating between, investing into, syndications versus a fund that was more of a like a feeder. So maybe you can expound upon that, like where an investment vehicle is tilted up that investors can allocate capital into that turns around and invest into a single deal. Is
Yeah,
that what you were sort of referring to? Like I call it like an
correct.
SPV, like a
Yeah.
single asset SPV.
Yes. So there are single asset SPVs. There are also fund of funds. So those single asset SPVs could be fund of funds essentially to invest in real estate syndications. It provides investors there are a couple of reasons why investors would want to invest in one of these. So a couple of them are the main syndicator might have higher minimums. So they might have a minimum of 100K or 250K.
Mm.
You then can create a fund manager might decide to create a single special purpose entity that enables investors to invest in this particular investment, but at a 50K minimum. So that then gives, once again, you might have 100K saved towards investing, and this enables you to put 50K into this fund, get that opportunity to do so without putting all of your money in it. You could then put your money into something else. And then you're probably thinking, oh, well, what about returns? So am I now going to sacrifice returns because I've chosen to do this fund of fund? And that's not necessarily. There are times it really depends on how the fund of fund is structured and set up. The beauty is you'll always know what the returns are before you invest. So you can then determine, hey, is this something I want to do or not? In a 506B offering, which is, SEC regulations, Reg D, 506B for accredited as well as non-accredited investors, you must have personal relationships with each of the person that you have in your deal. And those are the situations where creating a fund of fund could be beneficial because then that enables people that who do not have access, knowledge of this particular investment to then gain access to this deal. Now, even with a 506C offering, it could still be beneficial because, as I said before, the minimums, number one. Number two, the second thing is, from a return profile for fund managers who are able to raise 5 million, 10 million, 20 million, for these large deals, because there are very large deals that are out there that could use all of this kind of money. They are able to then negotiate better terms for their fund, which then could translate to even better returns for their investors, depending on the way in which they decide to set up their fund. So I think it's just really important to sort of be able to look into that and sort of see like how it all works.
Yeah, I agree. And I think that that's, one of the things that my day job at Verivest spend a lot of time, helping people. The fund managers we're speaking to here, I refer to them as, capital allocators, or they're more, kind of private equity, boutique or micro private equity real estate firms,
right,
who've developed relationships with operators, sort of done a lot of that due diligence, often with, our help at Verivest of verifying track records and,
sure,
running background checks and those sorts of things. But building those relationships with the operators is a lot of work, right? And so having people that are in the space to go out and build those relationships, and like you said,
right,
negotiate enhanced terms or enhanced economics, because if you're from the operator standpoint, right, like that's the big conundrum, as you referred to. It's sort of lower the minimum, to 50 or 25 or whatever. And now all of a sudden you've got that many more relationships or people you have to interface with. Well, oftentimes that's what they're short on, is sort of personnel on their team to deal with, handling all the managing all those relationships. So they inherently want to have higher minimums, one way or another. And certainly it's a heck of a lot easier for them to go out, negotiate a deal, to take down a deal has a $10 million equity requirement, and to get a 7-figure, $1 million or $2 million check from one investor is far easier than, getting that from 20 different investors.
100%.
It's the same sort of phone call. And so we're seeing more and more and more of that. And certainly we're doing our part to try to enable that to take place, because I think that when you look to like an adjacent market venture, as an example, you've seen over the last 20 years that same maturation has taken place. That's taking place as we speak in the sub-institutional real estate space. It's just the fact that you used to have these giant, venture capital firms, but then you've seen now, these much smaller venture firms sprout up that sort of do the same thing. It creates greater access for more people. This is sort of how it works, because it goes back to your diversification points. It's just, that's the issue, is that if you want to allocate capital to space, but if you've only got, especially if you were not accredited, but maybe you have a net worth of, $700,000, $800,000. It's not really prudent to be writing $50,000, $100,000, $150,000 checks into a single deal. And even a fund, because now you've got concentration risk on a sponsor, which oftentimes is concentration risk geographically and by property type. So it's hard to get that. Whereas the more people, and I think you're in this category of people who are now offering or serving as fund managers for this types of opportunities, is, it makes it easier to lower those minimums to something like 15 or 20 or 25. It allows non-accreds to get involved more often, once again, by following the regulatory requirements, which once again are completely manageable. And it's, so really, this is where I think we're going to see more of these things. But it is important, to your point, right, for investors to differentiate, but to also understand, right? Because oftentimes you do see some of these deals that they might be a 506B sort of SPV going into a 506B deal. Well, if you happen to be an investor who's on that operator's list, it could happen where you're receiving an email from two different parties promoting the exact same deal on the same day. And it is important for you to understand that, these are the points you got to really hone in on, is that they're just different doors. It's like having multiple entrances into your house. You can go in through the garage, you can go in through the front door. Right. And so in this case, just understanding what terrain you're going to have to traverse to go in through the garage versus there, and what the implications of that would be. Specifically, it's just going to be, well, to your point, well, is the minimum lower? Right. That's the first thing to check. Like, well, here they want 100 grand. Well, here they want 20 grand.
Right.
And and if that means that the net economics to you investing through the 15 grand door, they could be less. They might be the same or better. They could be. Right. And no one really knows, because it's only based on whatever's being projected. But ultimately, those are the things to kind of hone in on and understand what the differences are. And but you're seeing more and more of this. So it's like,
there's definitely a need. People want to invest in this space, and they're looking for opportunities to invest. So for sure, the need is definitely out there.
And I'm glad, like I said, I'm glad we see it, because it does, with us running like the sponsor directory on our website at Verivest, you're getting investors coming in, and that's far and away the biggest, their biggest sort of thing they bring up, is that these look like really great deals, but the minimums, are, the average minimum is probably $100,000. Right. And so they're like, it looks great, but it's just, for many people,
out of reach.
It's out of reach. Right. And so for us, I think this is what has to take place to kind of lower that. And even for us at Verivest, that's one of the things we've been working on, is piloting, is just a turnkey single asset SPV for folks like yourself and others like you, that just make it lower the bar. So for the upfront expenses to actually turn up one of these vehicles and the ongoing administration of these vehicles, because that's the other thing.
That is the other thing. And that comes with, that's the fund manager negotiating with the sponsors. And, that comes down to that. That's a part of like figuring out how, that all works, to then be able to provide the kind of returns that you want to provide to investors. So
that's right.
But I really think that there is, like, for me, I think my long-term goal is, like, I love recession resistant real estate. So I love multifamily, specifically Class B. But I also like, two other asset classes. Those are self-storage, mobile home parks. And I also like some ATMs as well. I haven't invested in those three other asset classes as yet, but those are asset classes that I'm continuing to look at and learn more about to then potentially invest in. And I could see where a lot of people would be interested in being able to get exposure to all of them, especially if you have identified those assets in advance, and be able to provide that, in a fund. That's one of the benefits of being able to be able to create this type of model, is that flexibility. And it might not happen day one, but it's something that you can do over time, based on what I said before, like creating that track record of continuing to sponsor, with good operators, and work with good operators, and being able to build that track record then provides the trust that people are seeing that they need to then be able to make the leap to that next step. So yeah.
Yeah, I agree. And I think that that'll be the progression, is sort of getting these emerging, fund managers doing, single asset identified deals. I mean, we've seen this in ourselves. I mean, that was the path that we followed. I mean, we had a series of debt funds, and we're private lenders, and we made the shift to becoming more private equity real estate people ourselves. And so my partner and I in 2012 made that, leap to operating, what it was, a fund of funds, in our progression. And it's just, so we're super bullish on this, is that I think there's value to be provided, right? Because of these dynamics. And it's a lot of stuff that people haven't thought through, but it is, when you think about it more from that, well, how do you deliver a diversification? And that's the thing. It's just that you want diversity, but it is, when you sit down and just run the numbers, it makes sense. Unless you're just independently wealthy and you're worth like 50 million bucks, then maybe it's not a problem. But the issue is just that even at 50, 75, or 100, and you just look at what your exposure is by making those investments, you're really overweighted. And I know it's fun, and you see a lot of hobbyist behavior from the passive investors or LPs. It's exciting. It's kind of fun to do, but if you really pan out and just think like, okay, you're a little overweighted, because things can go wrong. That's why I'm passionate about kind of the ongoing oversight and monitoring, because I think one of the biggest risks that goes unchecked in any one of these private placements in the real estate sector is just a lack of oversight and monitoring. And it's present, and it's there, and everyone can say they're going to do the right thing when no one's looking, until something bad happens and they choose to do the wrong thing. Right. And then they do the wrong thing, and they zig when they should have zagged. Next thing you know, that 50 grand you invested, somehow becomes zero. It happens. And that's, to someone who was only, if you were that non-accredited investor who went into the deal and you only had 700 grand or whatever it was to invest, now all of a sudden you just lost 10% of your portfolio in one deal. So those are the other sides of it. It's like, how do we eliminate some of that unchecked or, unmitigated risk? Well, providing ongoing oversight, right? Those are the sorts of things that I think can just make sure that when the moments of truth sort of occur, that the sponsors, make the right decision, which is sort of, hey, this happened, that happened, here's where we're at, be more transparent with it, instead of like trying to recover and cover it up and think that they can figure it out, and then not, and then have something, bad happen. And unfortunately, those are the things that occur. But getting the diversification is I think the key to kind of further mitigating some of those risks, where how can I make one allocation and get exposure to multiple investments, or at least be able to make a bigger number of smaller investments.
100%. And what you brought up here is super critical. And I don't know if many passive investors really look at the quarterly reports that operators send out, the P&L specifically, to see what the NOI is, and looking at how to even P&L works. Because as I was sharing with you, one of the deals that I invested in 2019, the plan was to do a lot of value add work in 2020, and given COVID, it was unable to do so. And looking at the quarterly reports, I could see that it was trending a negative NOI every quarter. They would kick these reports out. And I was therefore not surprised when early January of 2021 came and they mentioned that the property was now put on the market. And by March, they had a buyer. So, like, for me, I feel good that the operator decided to make that decision as opposed to, as you alluded to, trying to make it work and try to catch up and do all these things. Sometimes it's better to sell it, in this case at a 30% gain, and give people back their money, a little bit of gain, and then they can move on and invest in another deal. Yeah. So I think, really, I want to say it's important to invest with the right operators, but really and truly, sometimes you don't really always know until you're in the situation with them, when something like COVID happens that interrupts their business plan and puts them in a situation where they're unable to increase rents to the place where they want to. Because the reality is it takes time to make renovations.
Yep.
It doesn't happen overnight. So when you are interrupted from executing on the business plan, it does impact returns without a doubt.
That's right. Yeah. And that's just it. It's I think people misinterpret, I'm zealous and passionate about this particular topic, but at the same time, it's like what I'm not saying is that I believe that the vast majority of people will do the wrong thing in the moment of truth. Like I don't believe that. I fundamentally believe people are good and they'll make right decisions. Right. And so like the group you're talking about, hey, confronted with a reality that they didn't plan for. I mean, many people didn't, right? They make the decision. We're not going to try to press through and begin to execute the business plan as laid out due to the circumstances. We're going to go ahead and position this to sell instead of trying to, to push the envelope. Because once again, we're trying to turn over the units when you've got a moratorium on evictions. Like all these variables changed, right? And so every asset's different, every location's different, every sponsor's different. My big thing is just saying, it's easier when we're being, it's the whole, those studies they did with children, they bring 5 kids in and they have a cupcake in the middle of the table, and 4 of the kids just eat the cupcake. They don't have any restraint. The other kids, just like they said, don't eat the cupcake, so they don't do it. Right. As far as the kids know, they don't realize they're being recorded. Right. And so it's just, to me, like, it's probably not that dramatic, with adults who have reputation risk and all sorts of other things. But we all know, right, that same sort of thing is that when they're kind of like, well, no one's really paying attention anyway, let's just press forward because we don't want to deliver bad news, right? Or whatever the reason is. So for me, it's just saying, if we have a little bit more public accountability, right? And I just think that the percentage of people who will do the right thing and have the integrity, right? And then be integrous and that sort of thing increases. And I think that's good for everybody, because to me, it's just a risk. We just want to mitigate the risk.
Yeah.
Hey, do the right thing. Yeah.
The ultimate way, one other way that I think is that the risk could be mitigated is, if the industry added audits, that could help. It's just going to adding that is going to impact returns for investors. So, that's just something to consider. But at the institutional level, audits are required because, you're playing a different game at that place.
I agree. And that's where, and I think that's one of the things that I call like our ongoing monitoring service we provide at Verivest is Audit Light. Because for me, that's the issue with audits, is that to conduct the audit in accordance with GAAP, there's a bunch of stuff that ends up not being applicable, right, to the non-institutional, like fair value and all this sort of stuff. Well, the problem is you go hire an auditor to do an audit. They're like, well, I have to do all this stuff. It doesn't matter to me that this asset's 10 times smaller than the other one I'm doing. Like, I have to do all this stuff. I got to check all these boxes and it's going to cost 15 grand. Right. And we feel like you're getting a good deal. Of course, the operator's going, $15,000 a good deal? Like, doesn't seem like a good deal. So it doesn't work. And so for me, being in this industry for as long as I've been, it's like, there's got to be another way. How can we give the assurance that the audit provides, which is what I think most investors are after, without all the extra stuff that no one, because investors don't care if the financials are in accordance with GAAP. I mean, like, they don't have any requirement. It doesn't matter.
Sure.
Right. And so you get rid of those things and you replace it with, where's the oversight? Who's making sure that the fees are
Yeah.
calculated correctly, that these assets actually exist and they're not just fabricated, or that,
Sure.
like the things that can be done, and striking that balance where now it's not an affordability issue anymore, because that's what a lot of people use. It's too expensive, which it is.
Right.
So now it's like, well, that's not a legitimate excuse anymore. It's sort of like, do it because it provides peace of mind and it does mitigate risk, right, for the investors. Because otherwise, and I try to explain this to the sponsors, like, you got to think of it the other way, is that they're going to want to be compensated for the risk. Now, they might not say it might be subconscious, but they're going to say, well, the risk is there, so pay me more to account for the risk I'm taking. So I'm thinking, to me, you might as well do it so you can say, well, I've taken that risk off the table.
I see. Interesting.
You see what I mean?
Interesting.
Like,
Interesting.
But this is a guy who has a podcast talking risk all day long. So,
but a part of having this podcast, you're at least evangelizing people about it, which is good. I come from an audit background, so I know when I present many of these deals to auditors, they do ask about whether financials are audited and stuff like that. So it's a conversation.
That's right. Cool. Well, where can people learn more about you? Where can they find the podcast? Where they connect with you?
Yeah. So simple, one-stop shop for everything. LisaHylton.com. And that's Hilton like the hotel, only thing with a Y. I do have a free ebook on a beginner's guide to investing in real estate syndications. It's also lisahylton.com/ebook. But other than that, everything is on my website, from my podcast, The Level Up REI, my blogs, videos, all of that good stuff is on there, providing a lot of content and education, helping people to, make that investment into their next real estate syndication deal.
Cool. Awesome. Well, that was great, Lisa. We'll probably have to have you back. There's so much to talk about. Good stuff. LisaHylton.com. Thanks so much.
Yes. Thank you.
Take care.